Welcome back to the deep dive. Today we're tackling a stack of documents that, let's be honest, most of you probably try to ignore.
Yeah.
We're talking about that final exhausting hurdle when buying a home in Malaysia, which is the loan insurance.
It's the classic, gloss over moment. You've just signed 50 pages of documents. Your hand is cramping up.
Completely numb.
Right. And then the bank officer just slides one last form across the table.
Exactly. And usually you just see this alphabet soup, MRTA or MLTA. So our mission today is to look at the guide articles and the comparison tables we've gathered to answer one very specific question. Which one of these actually protects your family, and which one is really just protecting the bank?
It sounds a bit cynical to put it that way, but when you look at the structure of these policies, that really is the defining difference.
Okay, let's unpack this. We have MRTA, mortgage reducing term assurance, and MLTA, mortgage level term assurance. So the cheat sheet is basically in that middle letter, reducing versus level.
Right. MRTA is tied directly to the debt. So as you pay off your loan over 30 years or so, the amount you owe drops, and the insurance coverage drops right alongside it.
Okay.
It's designed to hit zero exactly when your mortgage does.
So it's basically a vanishing shield, whereas MLTA, being level, stays flat. If I'm covered for $500,000 ringgit today, I'm covered for $500,000 in 20 years, even if I only owe the bank a tiny fraction of that.
Exactly, which means there's a surplus payout at the end of it. But there is a much darker detail in the fine print here that most buyers miss. It's not just about how much is paid out, it's who actually touches the money.
Yeah, I flagged this in the reading material. They call it the beneficiary trap. Walk us through this, because logically, if the insurance pays off the house, your family should be safe. Why do the sources say otherwise?
It comes down to estate law. With MRTA, the bank is the master policyholder. If something happens to you, the insurance pays the bank directly. The debt is settled. Which sounds great, right?
It sounds great on paper, yeah. The house is paid for.
But legally, the house is still an asset in your name. Since the insurance money never went to your family, it went to the bank, your family is left holding a paid-off house that is still stuck inside your estate. And if you have other debts, unpaid taxes, personal loans, business liabilities...
I see where this is going. The creditors can just come for the house.
They absolutely can. The sources are very blunt about this. If your liabilities exceed your assets, the house, even though the mortgage is gone, can be liquidated to pay those other debts. Your family could effectively end up with, as one source explicitly put it, peanuts.
That is a massive blind spot. So how does MLTA architect around that?
MLTA functions more like a private life insurance policy. It sits completely outside the mortgage, so you can set it up as a trust.
Right. The articles mentioned a specific law here, Section 116(6) of the Insurance Act of Malaysia, 1996.
That is the magic bullet right there. That section essentially creates a legal fear wall. It states that insurance money paid to a specific nominee, like your spouse or kids, does not become part of your estate.
So creditors cannot touch it.
Exactly. The cash goes directly to your family's bank account. They can choose to pay off the house, or if the interest rate is low, they can just keep the cash and keep paying the mortgage. They have control, not the bank, and definitely not your creditors.
Okay, that makes MLTA sound like the obvious winner here, but we have to talk about the cost. There's an obvious reason banks push MRTA.
Convenience and cost. MRTA is a lower one-time lump sum. You can usually just finance it into your mortgage amount. You pay for it over 30 years with interest. It's totally set and forget.
And MLTA hits the monthly budget.
It hurts more in the short term, yeah. You pay a premium every month or year. However, unlike MRTA, which is zero cash value at the end, MLTA accumulates cash value. It acts kind of like a savings account.
Plus, the transferability aspect seems huge for a modern homeowner.
Huge. MRTA is glued to the property. If you sell that house or refinance, that policy is essentially dead. You have to buy a new one for the new house, and since you're older now, it's going to be way more expensive.
But MLTA follows the person. You move house, you take the policy with you, no new medical checkups, no price hikes based on your age.
It effectively shifts the power entirely from the lender to the family.
It really changes how you view that final admin hurdle at the bank. So to summarize all the sources, MRTA clears the debt but leaves your family exposed to probate and creditors, while MLTA puts cash in hand, bypasses creditors, and builds savings.
That sums it up perfectly.
Here's a thought to leave you with, something the sources hint at but don't ask directly. We often buy insurance for peace of mind. But are you buying peace of mind for yourself, knowing the box is ticked today? Or are you actually buying security for the people who will have to live in that house after you're gone?
That is the million ringgit question.
Thanks for joining us on this deep dive. Make sure you read the fine print.